Welcome to the deep dive. Today we're really digging into some specialized financial strategy. We've gone through quite an extensive guide, basically a massive Q&A session, all about passive investing.
Yeah, and it's specifically tailored, which is key. It's for you, the European investor.
Exactly.
And this deep dive, it's really about, well, optimization, isn't it? Most investment advice is pretty generic.
Right.
It tends to gloss over the real hurdles people face investing across borders in Europe. You know, tax, currency issues, moving countries.
Yeah, the messy stuff.
Precisely. So our goal here is to pull out the really actionable bits, the knowledge that tackles these specific problems. We want to help you turn those potential headaches into, well, workable strategies.
That's it. We're assuming you're maybe past the investing 101 stage.
Right.
If you already get compounding, you understand ETFs, this is about refining things. We're synthesizing the best advice from this Q&A on building wealth efficiently and, crucially, navigating that sometimes confusing cross-border finance world within the EU.
And what jumps out straight away from the source material is this push for immediate action. Doesn't matter how much capital you have to start.
Okay.
The guide is really clear. Waiting for the perfect moment or a big lump sum. That's just, procrastination.
Huh? Yeah, sounds familiar.
It really is. Consistent investment, even if it's with small amounts, that's what gets the compounding going and builds that all-important discipline.
So laying the groundwork fast, the absolute core strategy hammered home is, well, it seems non-negotiable.
Yeah.
A diversified, low-cost ETF portfolio. It sounds straightforward, but let's break it down. Why that specific combination, diversified, low cost, and ETF structure?
Right.
Why is that the ultimate blueprint for passive success, according to this?
It really boils down to mathematical efficiency. Long term, anyway.
Okay.
Low cost, that's obvious, right?
Right.
You minimize the drag on your returns. Even a tiny fraction of a percent makes a huge difference over, say, 30 years.
Huge.
And the ETF structure, that gives you instant broad diversification. You're essentially buying the whole market or large chunks of it.
So you ride the general upward trend.
Exactly. Without trying to guess which specific company will do well. You avoid that specific company risk. The guide basically frames it as the highest probability path to building wealth.
I like the focus on probability and efficiency, but, people hear constantly about the next big stock or you've got to time the market. Did the Q&A tackle that?
Oh, absolutely, and very directly. The analysis basically dismisses short-term market timing, calls it ineffective, speculative.
Detrimental even.
Yeah, detrimental to passive investors. The whole philosophy presented is that trying to jump in and out, buy the dips, sell the peaks, it just adds stress, emotion, effort.
And doesn't reliably boost returns.
Doesn't reliably boost returns? No. The steady approach, just consistently investing, dollar cost averaging, that's championed as the better way to manage risk and just stay invested for the long haul.
So the tortoise definitely beats the hare in this view.
Pretty much.
And this leads us nicely into the other big risks the guide flags, beyond just bad timing. It really stresses the danger of picking individual stocks or sectors. Sets a clear hierarchy, doesn't it? Broad market exposure first. Speculation.
Yeah.
Way down the list, maybe never.
Precisely. If you've committed to a long-term passive strategy, then suddenly deciding to bet big on one stock, it kind of undermines the whole approach.
Right, it's counterproductive.
That discipline is key. Because, as we're about to get into, European investors, they already have enough complexity on their plate without adding unnecessary, specific stock risk.
Okay, let's unpack that. This is where we get into the really high-value, tailored stuff for our listeners. The big challenge for so many is they don't operate in just one neat financial box.
No, it's not like that.
People move, earn in one currency, spend in another. So what concrete, actionable advice did the guide offer on those three main complexities for Europeans investing across borders?
Okay, yeah, this is the real core of it. First up, tax. Tax implications. That's probably the single biggest headache for most people. Definitely. The guide really emphasizes prioritizing investments in UCITS compliant ETFs.
UCITS. Okay, maybe a quick refresher.
Sure. UCITS is basically the European regulatory framework for investment funds. Using funds domiciled under UCITS, well, it massively simplifies cross-border tax reporting.
Ah, okay.
Plus, they're operating under clear EU investor protection rules. So it's kind of the baseline for compliance.
Got it. UCITS is the starting point. But tax rates are all over the place in Europe. Does it get into optimizing the structure beyond just compliance?
It does. The guide synthesizes advice pointing towards seeking out country-specific, tax-efficient wrappers or accounts.
Wrappers, right.
Yeah, like using the PEA in France, for example, or if you happen to have ties to Ireland, maybe a SIP, a self-invested personal pension,
Okay.
or certain brokerage accounts in Germany that treat accumulating versus distributing funds differently for tax purposes. The concrete advice is find these local tax shelters first. They can dramatically cut down your reporting burden and potentially lower your capital gains tax when you eventually sell or move.
That is incredibly valuable. Okay, challenge number 2, currency risk. If I'm earning euros, my life is in euros, but my global ETF holds loads of, say, US dollar stocks. I'm exposed, right? What's the strategy there?
Yeah, that's a real risk. The guide doesn't give one single answer, but it offers a framework for thinking about it.
Okay.
It suggests that if your main spending currency in retirement is likely to be stable, like the euro, then you should seriously consider currency-hedged versions of your global ETFs.
Currency hedged.
Yeah, especially for the parts tracking non-euro markets like the US or Japan. Hedging aims to neutralize the impact of the exchange rate moving against you.
So it smooths out the ride a bit.
Exactly. Provides more stability relative to the euro, although it usually comes with a slightly higher fee.
There's always a trade-off.
Always. The key is trying to align the currency exposure of your main assets with the currency you'll eventually be spending.
Makes sense. Okay, third complication. This one's less about markets, more about life changes. Actually managing your finances when you physically move across borders.
Right. And this is where planning ahead is absolutely critical.
Okay.
Well, imagine you've built up a nice portfolio over 5 years while living and paying taxes in, say, the Netherlands. Then you get a great job offer in Spain and move.
Okay.
The guide specifically warns about nasty surprises, potential tax events triggered just by changing your tax residency.
What kind of events?
Some countries have exit taxes, or they might deem your assets as sold the moment you become a tax resident there, triggering capital gains tax.
Ouch. Even if you haven't actually sold anything.
Even if you haven't sold. So you absolutely have to figure out how to transfer brokerage accounts, understand how Spain, in this example, will tax assets you bought while living in the Netherlands before you move.
Wow.
The core message is map out the financial side of an international move at least 6 months ahead, minimum.
Well, that advice alone shows why generic guides often fall short for Europeans. Okay, let's pivot now towards the long game. Using all this knowledge to actually plan for retirement, create passive income.
Yeah, the guide shifts gears here, moving into the calculation phase. How do you actually figure out how much you need and how to draw it down sustainably?
And this is where the 4% rule comes in.
Exactly. It introduces the 4% rule as a fundamental planning metric. It helps you estimate the size of the nest egg you'll need for retirement.
Now, the 4% rule gets thrown around a lot. But for this audience, we need a bit more context. It's often based on historical U.S. data, right, from studies done decades ago.
That's a really important point.
So why should European investors, facing different tax environments, maybe different interest rates, pay attention to it? And crucially, how should they adjust it?
That's the critical nuance the guide gets into. Yes, the original 4% rule suggested a high chance of your portfolio lasting 30 years if you withdraw 4% in year 1, then adjust for inflation each year after.
Based on U.S. history.
Heavily based on U.S. stock and bond performance history, yes. So the guide advises European learners to see the 4% rule as a starting point for their calculations. A benchmark.
Not the final answer.
Definitely not. It strongly suggests stress testing that number with more conservative assumptions. Maybe plan around a 3.5% withdrawal rate or even 3%.
Why lower?
To account for potentially lower expected real returns in some European markets compared to historical U.S. returns or different tax treatments on capital gains or dividends across Europe.
Okay.
It actually points towards using specific simulation tools, some mentioned in the guide, to calculate your own personal safe withdrawal rate based on your actual portfolio allocation, your location, your time frame.
That's much more tailored. Okay, now this is where things get really interesting, I think. The guide covers the long-term planning, but it also tackles some very current speculative worries floating around. Specifically, this idea of potential bubbles in AI stocks or even in broad market indexes themselves. What's the context the guide provides there?
Well, the concern it reports on, and it's careful just to report the discussion, not necessarily endorse the bubble view, stems from market concentration,
Concentration, meaning?
meaning that a huge chunk of the recent gains in global market cap weighted indexes, think MSCI World, S&P 500, has been driven by a very small number of giant tech companies.
The Magnificent Seven and related AI players.
Exactly. So this massive concentration makes some people worried that if just these few stocks stumble, the whole index is overly vulnerable, which leads to talk of an index bubble.
Ah, I see. So the structure of the index itself fuels the perception.
Precisely. And that ties directly back to the risk we discussed earlier, the danger of concentrated bets, even if it's concentration within an index.
So it becomes another argument for diversification.
A powerful one, yes. The guide's perspective seems to be, if you perceive an index as being top-heavy because of market cap weighting, the smart passive investor's response isn't to try and time the market or short the tech sector,
But
but to ensure your overall portfolio is truly globally diversified. That means including allocations to maybe smaller companies, different regions, emerging markets, value stocks, things that aren't caught up in that specific concentration wave.
so diversification is the shield.
Essentially, yes. The message is clear. Rigorous, broad diversification is your best defense against these kinds of localized market risks, whether they turn out to be real bubbles or just perceptions.
That pulls everything together really well.
Yeah.
Okay, let's try and summarize the core actionable takeaways we've extracted for you, the listener. First, start investing consistently, even small amounts. Prioritize those low-cost, diversified UCITS ETFs for long-term efficiency.
Absolutely key.
Second, really respect the unique challenges of European finance. Plan ahead for cross-border tax issues, especially when moving. And think strategically about managing currency risk, maybe using hedged ETFs if appropriate for your spending currency.
Proactive planning is crucial there.
And finally, use foundational planning tools like the 4% rule, but critically don't just take the number at face value. Adjust it down, use conservative rates, maybe run simulations to figure out your sustainable withdrawal rate in a European context.
Yeah, personalize that calculation.
Okay, so that covers the main points. Now for a final thought to leave you with.
Okay, so building on everything we've discussed, here's something to consider. We know you need to look for those local, country-specific tax wrappers, the PEA, the German broker structures, et cetera, for optimization.
Right.
And we've just discussed the potential concerns about over-concentration in the big global indexes. So the question for you is, how might you strategically use regional or even country-specific ETFs within those tax-efficient wrappers? Could that be a way to achieve both goals, simultaneously getting the tax benefits and ensuring you have that rigorous diversification? Maybe tilting away slightly from the mega cap dominance, effectively addressing both tax optimization and perceived market risk in your own portfolio.
Interesting. Using local wrappers for targeted diversification.
Something to think about. Use the specialized insights from today's deep dive to guide that kind of strategic planning.